Hello, everyone. Today, I am honored to have Bart Davis on the show. Bart runs 512 Financial, recently voted as Austin's best place to work. So Bart, great to have you on.
Thank you. Just in fairness, it's one of Austin's best places to work. We were not singled out as the best, as much as I would love to say that.
But first, this episode is brought to you by Convert.ai. Convert.ai helps B2B SaaS and services hit their growth records. For the past decade, they've helped companies from YC, A16Z, Seed, Series A stage companies, all the way up to the likes of BitGo, Adecco, Microsoft, SEMrush, Coke, hit growth records by handling their end-to-end demand generation. If you're interested in working with a partner that handles your end-to-end demand generation and actually works on a performance basis, putting their skin in the game to help your company grow, get in touch. The domain name is convert.ai and the link to book is convert.ai/book. With that out of the way, let's move on to the show. Maybe that's a great place to start. That's still quite an accomplishment. There's no shortage of startups out in Austin. I'm curious, what do you think contributed to getting ranked on Austin's best place to work?
You know, everyone will use the buzzword culture, right? We have a good culture, and we do. But you know, the kind of the way that we've gone about building that is obviously creating a super flexible place to work. A place that's exciting and intriguing to people. But like fundamentally, like just super tactically, every 6 months we do internally we run the Q12 survey. It's a tool from Gallup that measures employee engagement. So it's different than employee satisfaction, which you might think of like an NPS or an employee NPS score for satisfaction. This is employee engagement. So there's 12 questions, things like, do I have the materials that I need to get my work done? Has someone praised me for something I've done or recognized me for something I've done in the last 7 days? Do people at work care about me? Do I do work that I care about? Things of that nature. And so we do that every 6 months. We measure ourselves against prior performance. We measure ourselves against similarly sized businesses, similar industry businesses, et cetera. Every single one of those that we do every 6 months, there's always some takeaway. So then when it came to applying for Austin's best places to work, survey went out to all employees at any company that applied. And those questions very closely mirrored, as it turned out, what we were doing already. And so these were things that our employees had been asked and that they had seen actioned on already. And so, yeah, that sort of yielded itself nicely to us performing well in that survey.
A good place to also talk about, I think before the call, we were talking about what you over-index on when it comes to hiring and how you get great people on board in the first place, which I think contributes a lot to that as well. Yeah,
absolutely. So yeah, two things I think we keyed in on. One is that one of our, if not our most important interview is what we call our core value interview or a culture interview. And so just as important as, can you do debits and credits and can you close the books, are you a fit for for what we do here from a core values perspective? And so that's a huge part of it. And then the other, which is kind of similar, is that as important as those technical skills are, which is very important, that just being an enjoyable person to be around is maybe more important, to be around and to work with. Because obviously we spend a ton of time with each other and with our clients. And if that is not a pleasant experience, then people won't work with us. So yeah, I think those are the two things that we kind of keyed in on.
I love that. The culture interview. Every company should be running a cultural interview and vet for that alignment. Even if the technical expertise is there, it's so important that they blend well with the company and the ethos of those cultural values and what the company stands for. So I'd love to hear your abridged background story of how you started in finance and worked your way up to being a founder, running a thriving, growing business.
I started my career in public accounting. I worked for PwC in Houston. And after not too much time, a lot of hours, but not too much calendar time, I was approached by a guy here in Austin named Joel Trammell, serial entrepreneur. He's been building and scaling businesses for about as long as I've been alive. And at the time, he was the lead investor and board chairman in two 60 to 80 person software companies, was outsourcing the accounting function to India, which is of course a cost effective method to filling that need, but sometimes that there are factors beyond just cost. He brought me in back in 2014 to build a team to service those two companies. So he liked that shared resource model, but wanted them to look and feel like employees rather than be on the other side of the globe. And so came to do that in 2014, helped scale those two companies until they were acquired, one in 2018, one in 2021. And kind of late 21, officially beginning of 22 is when we spun what was, my small team directly under Joel into what's now 512 Financial.
Beautiful. I imagine you've worked with all types of companies, fashion company, SaaS company, tech companies, a lot of venture-backed, Series A, Series B, even C stage, early and mature phase startups, as all of the same. I'm curious if you've noticed universal truths between how these companies should run themselves from the perspective of tracking their finances and their company health. Are there 3 metrics you would recommend every founder track and monitor obsessively to pulse on the health of their business?
Depending on the industry, there's maybe a slight nuance to some of these, but certainly in the tech and the SaaS world, retention is one that's massive, and that can mean for non-SaaS companies that can mean something else. Like, do your customers come back to you for more? Basically, is like the simplest way to put that. So yeah, some sort of retention or repeat business metric, because of course it's the cheapest to get more or get more of someone you're already doing business with than to go acquire a new logo. Kind of on that topic, the CAC to LTV ratio. So CAC standing for customer acquisition costs, think sales and marketing expense. LTV, lifetime value. How much do they spend with you while they are a customer? Generally speaking, if companies can get that ratio at or above 3-to-1, it's considered pretty darn good. And then the third one I would say is what's called the rule of 40. So the rule of 40 refers to if you at any point in time add your growth rate year over year, or I suppose it could even be quarter over quarter, with your profit margin. So if, and using that, you can be skewed one way or the other. You can be growing really fast with minimal profit or maybe even slightly burning, or you can be really profitable and not growing a whole lot, or some healthy split between the two. But so if those two numbers equal 40 or more, again, considered very, very healthy.
Yeah, and I imagine that helps on the valuation front too. If you hit the rule of 40 and you got good retention.
Yes. If you can marry those 3 things, if you can be a rule of 40 company with great retention and a great CAC to LTV ratio, yeah, you're going to have quite a valuation.
Love it. So you've been growing fast the past few years. And a lot of startups in Austin and across the US work with you guys. What are some growth hacks or some tactics that you've deployed that you think contribute to having grown so quickly and having picked up so much business?
One, on the hiring side, in addition to what we've already talked about in terms of like the interview process, so we have gone from 4 to 33 people in the last 30 months or so. Probably 85-90% of those hires were somebody in the business had already worked with. Obviously, it's a known commodity, and it's also yielded a way for our existing employees to get a little bit of extra comp because we'll do employee referral bonuses. Sounds like, oh man, more spend for a startup. But if you compare that to what you'd spend with a recruiter, it's pennies on the dollar, So that's one. In trying to sort of growth hack our way to more awareness, an accountant by trade, I'm a cheapskate. So we have not spent a ton on marketing, but we still want to do things like have more followers. And so one thing we kind of realized by accident sort of early on is that every employee on LinkedIn has the ability to invite LinkedIn connections of theirs to follow 512 Financial. So just making people aware of that. And then building some little internal competitions around that. We've done it. We've done little teams of 4 or 6 people. We've done individual competitions that, hey, whoever can get the most new LinkedIn followers this quarter, this month, or whatever gets a Starbucks gift card, or, it doesn't have to be something big, but it just kind of creates a fun competition that has helped us build our follower base and our awareness of who we are.
Beautiful. Yeah, I love that. I love that it's leveraging the team and their connection to grow your LinkedIn company profile without, LinkedIn's not cheap if you throw up ads. It's one of the more expensive platforms. So this is a great way to grow it without a giant amount of spend. And the degree of legitimacy you get from a lot of LinkedIn followers on your company is vast. It's really immense, the value from that. So how do you, are there any other tactics that you've deployed to pick up new business that contributed to such growth from 3 to 33 people in 30 months?
almost all of our new business comes from referrals. So earning those happens slowly. It's not like, you hire a big sales team and they go and sell stuff, right? Like these are relationships that are built over a number of years. The one sort of like quick hitter thing that is still tied to that concept is if or when we see relevant roles get posted on LinkedIn in our network. So, a VP of finance, a controller, a senior accountant, an HR person, whatever it might be, we'll reach out to either that job poster or that CEO and say, hey, I noticed this role. There's another way to fill it besides just trying to go hire a full-time person. And oh, by the way, like I noticed we've got a bunch of the same people from ABC Ventures, in our shared networks. We may actually have already kind of unknowingly done some work together. Let's talk about it. And, obviously it's cold outreach, but it's cold outreach with the relationship component tied to it. And we have seen some success from that.
That is so smart. So yes, cold outreach, but you could call it connecting the dots.
Sure.
Or showing that there's some sort of personal component behind it and mining their network to see if you have any that you could use, even if it's just name dropping. I mean, if you want to grow a podcast, the first thing we do is look at who they're connected to. And if who's been on the show before, it's such an obvious way to make the ask is, hey, Keith has been on the show. You know him, you're connected to him. Would be great to have you on too. So that's a genius tactic. I post things on LinkedIn, for AI engineers, for instance, and no one personalizes it. It's just, hey, we're a dev shop. We can fill that thing for you, but no one connects the dots like how you guys did it. And if someone did, I might actually reply to them. So amazing insight. Is there anything else you would go back and tell yourself 30 months ago before you literally 10x the size of your team and you grew so quickly? Would there be any word of advice, insight, avoid this or do more of this that future Bart would tell past Bart?
I think I would just tell me to buckle up. I mean, it's truly a wild ride. Like it's crazier with higher highs and lower lows than I think I expected. I use this saying in another when I was chatting with someone else at one point that I over time learned to sort of embrace the turbulence and try to like figure out how to find an even, kind of a more even keel. But it took me a while, and I still occasionally have times when I just kind of wake up and go like, holy crap, like I have 35 people who are kind of reliant on me to make sure I'm doing smart things with this business. And it's something that I take very seriously. And it's like a terrifying, awesome challenge. So yeah, I don't really know what I would tell myself other than just like be prepared for quite the ride.
That's true. A lot of founders summarize it as extremely high highs, extremely low lows, multiple times over. And that's all in a given day before noon.
Yeah. Right. That's just before dinner.
To expect that.
Yeah.
Correct. So that's amazing. So buckle up, have fun, but take it seriously all at the same time. Love it. Excited to see you continue to grow. Excited to see you guys to continue picking up business from VC stage companies all across the States and help those companies get a pulse on their metrics and hitting the rule of 40.
That's right.
Super appreciate the time, Bart. Super appreciate the time. And thank you so much for coming on the show.
Yeah, thank you, Chris. I enjoyed it.